Good morning, this is Wayne Bilal and Tessie, who just dropped her treat, so I don't know what the heck I'm going to do with her. Anyways, here, it's down there somewhere, you'll find it. Anyways, with another smart profit maximizing moment. Happy Monday morning, it's November 4th, we're, believe it or not, in November. Prime tax planning time. All right, there's basically, let me do a better job introducing myself without the distraction of the puppy. My name is Wayne Bilal, I'm a local CPA in El Paso, Texas. Founder of my own CPA firm since 1991. Actually, been doing past CPA exam in the late 70s. So I've been doing this a long time. It's really three things we focus on. Obviously, tax returns. We do a lot of small business and their owners' tax returns. Helping part of the profit in maximizing, which is part of the reason for these videos. And of course, tax planning, which is what we're really gearing up and starting to do more and more between now and Christmas. It's about all we'll be doing. Thought I'd start with a review of the major changes that went into effect under the Trump Tax Act, okay, which is officially the Tax Cuts and Jobs Act. It was passed in late 17, went into effect for 18, so this is the second year there. But there's still, I'm finding, talking to a lot of my clients, there's still a lot of things about the new tax law that business owners just don't know or don't understand. So I thought a review would be good. Now understand, tax planning is important. We've saved our clients well over $4.4 million in the last 3 years alone. We'll pop past $5 million easily this year, all right? So tax planning is part of the reason, part of the major tools I use to increase profits for my business owners. It doesn't do you any good to make a lot of money and then turn around and hand it to the IRS. You know, I worked with somebody last week, saved them about 40 some odd $1,000. It's not chicken feed, okay? And we could have saved more, to be honest. But so what are some of the tax things? Well, let's talk about the ones that went away in 18, okay? Entertainment expenses. Before 18, you could deduct 50% of entertaining customers and other business associates. Under the Trump tax law, deduction is no longer allowed. So if you take customers to a ball game or to a play, you cannot deduct any of it. Recently issued IRS regulations allow deductions for meals with customers and other business associates before or after, all right? If your business has a net operating loss for 2018 or later, you can no longer carry it back to the loss to prior years to reduce that year's income and get the business a refund. Instead, the loss is carried forward until it's used up to offset future income. Business losses for higher income owners will be limited, all right? Excess losses are carried over. Reimbursements to employees are now included as taxable compensation, and you must now pay employment taxes on them. The gain deferral on vehicle and equipment trade-ins is eliminated for years after 2017. Not a big deal, but if you trade in a car, this is where you need to work with your accountant and make sure they have the information. If you trade in a vehicle, that has to be reported as a sale. Now, slightly different from before. If you had a $20,000 gain on a trade-in, you bought a new vehicle for $50,000, you could only depreciate $30,000, which was the $50,000 minus the gain you weren't taxed on. Now, you're taxed on the gain, but you get to deduct the whole $50,000, assuming it's the right type of vehicle, all right? This can create a situation, so be careful. The 90% domestic productive activity, which very few people used, is gone. Let's quit the stuff that went away. Let's talk about the major things that showed up, all right? There's plenty to be happy about, okay? The new law allows 100% first year Section 179 deduction for both new and used business assets placed in service for 2018. The phase out of this 179 deduction is $2.5 million, all right? So I get to deduct up to $1 million, and it doesn't phase out unless I buy a ton of it. So it basically means for most business owners, you're gonna be able to deduct 100% of all equipment. Large pickup vans, SUVs with gross weights of at least 6,000 pounds have to be used more than 50%, are deducted 100% for that year. Well, if you only use it 75%, 75% is deducted for that year. Property eligible for expensing now includes depreciable assets used predominantly to furnish lodgings. Examples are furniture, appliances used in hotels, apartments, and rental homes. That's a big one if you own rental property, okay? Commercial buildings can now expense roofs, HVAC equipment, fire protection, and security systems. This area is now much more complicated, truthfully, and you need to make sure that you get with somebody who's a qualified tax planner. Don't miss out. And this is probably the biggest one out there for most business owners. This is a huge break. Like I said, I've been doing this since the late 70s. This is a break that's specifically targeted right at the small business owner. And truthfully, that's rare. Usually tax changes affect the really low income or the really high income. And if we get anything in the middle, it's an accident. All right. Starting in 2018, only 80% of your qualified business income will be taxed. This is, like I said, a huge break for small businesses, but man, it's got a lot of complications, a ton of limitations. If you own a profitable business, you definitely need to contact your tax advisor to ensure that you don't miss out on this valuable deduction. Make sure you're not going to miss it. C corporation changed from rates of 15 to 35% to a flat 21%. This causes some business owners who are now taxed as S corporations or partnerships to convert to C corps. Really get with your business advisor for that. That's not that simple. Sounds like you want to jump into that 21%. And I've seen people do it without really understanding that when you take the money out of it, if you're planning on making money and taking it for personal use, you're going to get taxed again as dividends at least, or extra wages or something. So there's still about it with the 20%, with only 80% being taxable, that 20% Section 199A deduction, you're still usually around 8 to 12% better off in an S corp, with exceptions. So get with your tax advisor. And businesses providing family or medical leave to employees qualify for a new credit, generally 12.5% of wages paid for family and medical leave. This credit is only for 2018 and 19. Bottom line, with all the tax changes, 2019, like 2018 and moving forward, it's really, really essential that you meet with your tax planner before the end of the year and make sure that you're taking advantage of everything that you can. This is huge right now. The last couple of years, the last 3 are starting in 17 because we knew the law change was there, 17, 18, and now 19. Meeting with the tax planner is vital, all right? If you don't have one, contact me. We can do this remotely. It doesn't have to be, it's better if you meet with me, but it's not necessary, all right? Hey, until next time, this is Wayne Blau saying, enjoy November, all right? It's starting to get cool out there. Some of you are in areas where it's darn right cold, but in El Paso, it's beautiful right now. So, hey, come join us. Till next time, this is Wayne Blau saying, let's make this our most profitable year ever. Thank you very much.